Imagine selling a property, making a nice profit, and then being able to reinvest that profit into another property without having to give a hefty chunk to Uncle Sam in capital gains taxes. That's the magic of a 1031 exchange. A 1031 exchange, named for its section number in the Internal Revenue Code, is a swap of one investment property for another. Most swaps are taxable as sales, but if yours meets the requirements of 1031, then you'll either have no tax or limited tax due at the time of the exchange. So, it's a tax-deferred strategy that allows you to sell your investment property and reinvest the proceeds into another property without paying capital gains taxes at the time of the exchange. Now, you might be thinking, how does this work? The process can be broken down into a few steps. First, you sell your property. Instead of taking the profits from that sale, you hand it over to a middleman, often known as a qualified intermediary. This intermediary holds on to your money so you don't have to pay taxes on it. Next, you go shopping for a replacement property. The clock is ticking though. You only have 45 days from the date of the sale of your old property to identify potential replacements. Once you've found your replacement property, you have 180 days from the sale of your old property to close on the new one. If you meet these deadlines, congratulations, you've just completed a 1031 exchange. But what properties count as like kind? The IRS has a broad definition encompassing various types of real estate such as residential rental properties, commercial buildings, vacant land, and even other types of properties. Two pieces of real estate can be like kind if they're of the same nature or character, even if they differ in grade or quality. So, a residential rental property could potentially be swapped for a commercial building under a 1031 exchange. One property can be replaced by multiple properties. Now, what about this term boot? Boot is the term used in tax law to refer to any additional cash or property received in the exchange. If you receive boot, it is subject to taxation. Enjoy these benefits from your 1031 exchange. Tax savings. You keep more of your profits to reinvest. Portfolio growth. Accelerate the growth of your real estate portfolio. Diversification. Easily switch between property types or locations. Now here's where it gets exciting. You can repeat this process over and over again, continually deferring your capital gains tax until you decide to cash out for good. Just imagine the tax savings over time. It can be a game changer for building your real estate empire. A 1031 exchange isn't a tax avoidance strategy, it's a tax deferral strategy. If you want to learn more or need assistance with your sale and purchase, reach out to us. Don't forget to like and subscribe.